Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, it's our first episode of 2026, and as is our tradition, I'm going to jump into basically our Outlook report, a little summary of that. The report this year and the corresponding article is entitled Outlook 2026, Rewiring Growth. So if you think about that wording, maybe you'll get the idea that we're going to talk about artificial intelligence as a key capability that's going to influence the world going forward. Now, what I want to do is, though, walk through and kind of explain the actual report's structure, because there's multiple articles, and I'll just give you kind of a quick take on each one. And I want to go a little deep on 2025 performance in the equity markets, because there's some variety, I guess is the way to say it. But, you know, if you look at the website, stifelinsights.com, you can check out the full report, the video summary, a client webinar, which as I record this is coming up in a few days, but it ultimately will be available on replay as well. So anyway, let's jump into it. We entitled, again, the idea of rewiring growth, Outlook 2026, rewiring growth, to really capture the idea that artificial intelligence is changing things pretty quickly and corresponding policy and so forth. And yet, as we always do, we sort of start with a year in review. We take a look back at 2025, think of it as setting the foundation for our thinking for the coming year. And so, you know, I think that there are a couple sort of interesting quick observations about 2025. The first is that the shifts in DC, the shifts in policy, and candidly, the coverage of it sort of created an environment where there was a lot of sort of worry and angst and fear. But honestly, sort of the environment ended up resilient, right? Company earnings grew. We had the tariff scare in April, and the market's down a lot in April. But, you know, sort of the underlying resilience of both the economy and ultimately then earnings brought the market, and honestly, optimism around AI brought the markets back and ended up being a very good year. And I'm going to get into specific performance. Before we get to the markets, though, I'll just mention the economy. Another sort of interesting pattern is we had, you know, a modest contraction in first quarter in 2025. Then economists were sort of forecasting certain levels of growth in second and third and fourth quarter. And we've gotten official reports for second and third quarter, and the economy ended up doing a lot better than the consensus forecast. And so if we look at the consensus forecast for fourth quarter, which I think annualized is 1%, if that happens, we end up with a 2% GDP growth rate in 2025. And that's a decent sort of growth rate. But if the current analytical models, which are, I think, forecasting, call it 2.6 or 7% annualized growth in the fourth quarter. So the models are right now signaling a little more optimism. If we saw that happen, the growth rate for the full year is in round numbers about 2.5%. And so, you know, we'll see where it comes in. But the punchline for the economy in 2025 is, despite all the angst, it ended up being a very positive year. Now, turning to the markets, actually, it's kind of a similar story. With a little bit of a twist. And honestly, for those that kind of track this podcast and the content that goes with it, you know, essentially we published a special Sightlines on January 6th to dive into 2025 equity performance. And I want to walk through the substance of that, and then we'll get back to the broader report. So think of it as these different buckets of categories earning certain levels of return, but a little bit more wide-ranging than we would typically see. So sort of the winners this year, if you will, a little bit against a weakening U.S. dollar, were non-U.S. investments. So, you know, the MSCI EFA, for example, which represents developed markets outside the U.S., up over 30%. MSCI emerging markets, so the emerging markets outside the U.S., up over 33%. And again, a weakening dollar at very round numbers probably accounted for about a third of that. But still really good returns. Now, in the U.S., the Magnificent Seven, that's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, these tech stocks basically did really well. And that index, it's called the Bloomberg Magnificent Seven Index, was up almost 25%. The slightly broader NASDAQ composite was up over 20%. So I think tech-oriented, big tech companies, obviously AI enthusiasm, drove that. And so that's great. And, when it comes to the share of those companies, think of the top 10 in the S&P 500, including a lot of exposure to those companies, essentially the cap-weighted indices, so the S&P 500 and the Bloomberg 1000 were up over 17%, the S&P almost 18%. So that drove some really strong results. But, what's notable is that many investors and many professional asset managers invest on more of a cap-weighted base or a equal-weighted basis, meaning that they don't copy the market cap levels of the stocks. They sort of equal weight in portfolios. So there are indices that reflect that. The S&P equal weighted index and the Bloomberg equal weighted index, the S&P 500, Bloomberg 1000, were up 11.4% and 10.9% respectively. So think of it as a haircut to performance if you're equal weighted. And then finally, there are a couple categories that are super popular, understandably, in the world of wealth. One is yield. Hey, people want cash flow off their portfolio, so they lean into companies that pay higher and growing dividends. And, in a style sense, that particular area relative to cap-weighted results was a little out of favor. So, for example, the MSCI USA High Dividend Index returned about 12% for the year. And then the S&P 500 high dividend index, which has a little bit of a quality bias given their index construction, was up only 4.7%. Now, finally, an even deeper quality version of that S&P 500 low volatility high dividend index returned 3.7%. So you think of that range, right, where you've got the Mag 7 up almost 25, and then quality companies in the large cap space up 3.7. That's quite a wide range. Now, finally, that same pattern of quality influence, it showed up in the small cap space. So the Bloomberg 2000, which is a broad exposure to small cap, was up over 11% last year. But the S&P 600 index, which, again, the S&P construction includes a little bit of quality, that returned 6%. And then they actually do a quality index in the S&P 600 space that is even higher quality. It returned just 1.3%. So, the reason I wanted to go into this in a little bit of detail is if you're working with professional managers using mutual funds or separate accounts where you're leaning into quality in the large cap space or the small cap space, and again, maybe you're leaning into yield, basically, you should expect those results to be feel disappointing. They're still positive and decent in a way for a typical equity performance, but it's going to be a year where people are going to look at, let's say, a small cap quality manager and go, oh my gosh, this is so much less than having bought the Magnificent Seven. Did I do something wrong? And that, in my view, the answer to that question is no. Basically, these things come and go. The leaders become the laggards and vice versa. And so one of the things you want to be super careful about is chasing performance. It's a very common behavioral sort of error to kind of buy the highest returning thing. And then it typically often turns, and you've sold the lowest returning that sometimes becomes the better returning category. So all of that to say, you hear it all the time, stay the course and stick to your strategy and all that. So anyway, that's a little bit of a deep dive on performance specifically and the 2025 year in review. But turning back quickly to our Outlook report, we're blessed to have Brian Gardner, that's Stifel's chief Washington policy strategist. He provided an update on basically D.C. in a midterm year. And, we know that we're looking at the possibility of divided government. We know that things like trade, tariffs, industrial policy will remain central themes. And we're going to see leadership changes at the Fed for sure, just given Chair Powell's term is up. We did another update to what we call our geopolitical risk dashboard. A fragmented world was the article title, And basically, we're diving into risks, right? U.S.-China competition, cybersecurity issues, defense, and military hotspots, including Venezuela. Artificial Intelligence Runway for Growth is that article that dives deep into AI, seeing it as a long-duration growth catalyst. So hyperscalers are investing. There's the need for more chips, data centers, and power. Enterprise adoption is early but happening. So think of it as companies. And so we just know that there's a lot going on in the world of AI, and it's kind of shifting things. And then we did also offer an article, Fiscal Trajectory, Borrowed Time. Basically, the idea that we have elevated deficits, elevated government debt, and we have sort of a horizon within which we need to get that all worked through. Like we have to basically either earn more taxes, spend less money, and chip away at the outstanding debt that we have, especially relative to GDP. So good GDP growth is going to help with that. Anyway, we essentially offer 4 scenarios to kind of frame out different paths that we might see, ranging from so high levels of disruption to really great levels of growth. And then finally, we always pen an article within the broader report with the same name. So Outlook 2026, Rewiring Growth is basically the idea here is that we're, excited about and optimistic about AI investment, and that when it all comes down to it, that's going to, we'll see what happens in 2026, but that is going to basically, we think, change the average growth rate going forward, some amount. And so if 2.1% GDP growth is the trend, we might see, 2.5 or something like that. And while that may seem like a small number, when you compound that, that's actually quite significant. The idea with this, of course, is that it's improving lives, and it's going to make businesses run more efficiently. It's going to ultimately allow businesses to amplify their growth and amplify their earnings, and all of that is positive. We know that there will be a sort of a job market disruption, but the studies show that even though there's a shifting, right, certain jobs are being displaced, other jobs are being created, and the ones that are being created are sort of higher wage jobs. So net, again, even though there'll be some individual pain, we see it as a net positive. Now, other things that we're calling for is inflation cooling further. The Fed's still cutting rates 1 or 2 times towards the end of the year. Our target for the U.S. equity market is 74.50. That translates to a return of 10%. And so, again, we're generally optimistic. We do offer our bear case and bull case scenarios, and invite people to check that out. And then, as ever, there's content in the report about how we think about asset allocation, our investment management process, and allocation insights, which provides a little bit more granular guidance on opportunities in the market. For example, we think markets are going to broaden out. We think quality will come back into favor. And so we're sort of providing some more detailed guidance on that. As I mentioned, you can go to stifelinsights.com and check out the report. You can check out our Sightlines article that summarizes the report. You can check out our Sightlines article that summarizes 2025 equity performance. And obviously, a ton of work by the team through the balance of 2025, and a nice way to start the year in terms of offering this a set of perspectives for our clients and our financial advisors to kind of anchor on as we move into 2026. So super optimistic, recognizing there's some downside risk. Listen, thank you so much for listening to this, I think, slightly longer than usual episode, but we'll look forward to the year 2026 and sharing more as we go along. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.